Welcome back to the investment challenge. Today we have a very interesting topic. We are going to talk about cyclical and defensive sectors and why it's important to know this concept if you want to make money trading stocks, more short-term positions, 3 to 6 months. And we are going to start with this beautiful drawing I just made. It's very simplistic. It's displaying the business cycle, and the business cycle is just this line which represents the GDP. And normally there are only two modes. It's growth phase, or it's in the contraction phase. We basically only have these two. And when you think the GDP is growing, then you should only look to invest in stocks that are in the cyclical sectors. Why is that? It's pretty easy. The revenue of those companies that are in cyclical sectors are just profiting more when the economy is growing than stocks that are in the defensive sectors like consumer staples. I said in another video, when you buy stock of a company that produces toilet paper, it's not that important for the business how the underlying economy is doing, because you will always need that. But in contrast, when you are looking to, I don't know, upgrade your PC with a new graphics card, you will be thinking twice when you just lost your job and you think the economy is going down. That's why basically we always trying to determine what the GDP is doing. Will it be growing in the next 6 months, or will it be contracting? And let's just look at some not ETFs, at some sectors. I found this beautiful list. One moment, where is it? So I found this list, and here you can see basically just the sectors split it in cyclical stocks and non-cyclical or defensive stocks. And when you look at that list, it should be clear by now what that means. As I said, consumer staples, toilet paper is always needed, and when you maybe want to buy your new smartphone, here, then it would affect the semiconductors, and you will think twice when you think the economy is going down, if you should buy that or not. It's always important to keep that in mind when selecting your stocks. And now I have an example, and I will put this link in the description so you can check that for yourself. And now we have a nice example here. The yellow line is the S&P 500. Then we have the purple line, which is an ETF with just defensive stocks in it. It's the iShares Russell 1000 Value ETF. And then we have the Spider Tech Sector ETF, which is the green line. And here you can see it would be very beneficial when the economy was growing after the Corona crash if you just would have bought into the cyclical stocks, because they clearly outperformed the S&P 500. And of course, the purple line, it's very clear how this stuff works. But also, what you should look at is when the stock market is going down, when the market thinks the GDP is contracting, then it would be very stupid, let's say, to stay in that ETF, because it would be better to just be flat, have no open positions, or put your money back in this ETF or in more defensive stocks, because then you would be basically flat by now. You wouldn't have lost any money. So that's why you should always or it should be a priority for you to always look where we are in the business cycle. Is growth expected or not? And yeah, that's the concept of cyclical and defensive stocks. If you have any questions, just leave a comment below. Then I will make a new video about it. And yes, just have a great day.